For the very first time, I'm buying into a Vanguard Exchange Traded Fund. But with Vanguard offering a choice of many hundreds of funds, which one have I gone for? My decision may surprise you. I'm a dividend investor, and for the last 13 years I've been investing mainly in UK large cap companies with solid balance sheets and who pay streams of reliable passive income. The dividends I receive have now grown to an average of over £1,000 a month. And since 2009, the share portfolio has grown to a six-figure sum. Using a stocks and shares ISA means that all my dividends are tax-free. Some investors are only interested in capital growth, but it's the flow of dividends that really motivates me. Whereas the share price can go up and down literally by the second, dividends feel more real, and watching them grow year after year is a fascinating process. Some may say that I would have done a lot better by investing in growth stocks, but I wouldn't be as motivated, and I doubt I'd have stuck at it for as long as I have. So why am I choosing a Vanguard fund now after all this time? Firstly, I've gone for an ETF or exchange traded fund. When I first started out, ETFs were not mainstream and I could only buy individual UK companies on my Barclays platform. Some might say that this is not very diversified, with all my eggs in one big UK basket. However, I now own over 25 individual companies over a range of different sectors, and most of these companies derive much of their earnings from around the world. Having said this, I still really like ETFs, and I've been buying more of them recently, both UK-based ones and in the S&P 500. The great thing about ETFs is that you can buy a whole range of companies or commodities, even complete indices, in just one neat package. Now, I'd really appreciate it if you could give that like button a quick tap. Thank you. Before I reveal which Vanguard ETF I'm going to be investing in for the first time, I'll mention the most popular ones with fellow investors on my Barclays Smart Investor platform. The most popular at the moment is the Vanguard S&P 500 ETF. This ETF gives you exposure to the largest 500 listed companies in the US, all wrapped up in one share. The ticker code is VUSA, and you can see the main sectors you would have exposure to. Almost 27% would be in the tech sector. Tech companies such as Apple and Microsoft are big players in this ETF, making up over 12% of it combined. You would also share in the fortunes of Google, Amazon and Tesla. The tech sector has suffered this year, however, and the total performance of the ETF, which includes dividends, is down 2%. However, over the last 3 years, the return is an impressive 47%. Unlike buying a single company, there is usually an ongoing charge with ETFs. With this one, it's a very reasonable 0.07%. The dividend is 1.18% a year, split over 4 payments. Please remember that none of this is investment advice and is just for information purposes only. The second most popular is the Vanguard FTSE 100 ETF. The ticker code is VUKE, and it gives exposure to the 100 top UK listed companies. Consumer staples make up the largest proportion, which tend to do better than most in a recession. Here are some of the companies you would have exposure to with this ETF. With global markets being shaken this year, the FTSE 100 is holding up pretty well. And don't forget that most of these companies are global giants, earning much of their revenue from abroad. This ETF has returned over 2% this year, and over the last 3 years is up 10%. The ongoing charge is 0.09%. The dividends are 4% spread over quarterly payments. If you want exposure to UK mid-sized companies, then the Vanguard FTSE 250 ETF might be worth considering. It's the third most popular Vanguard ETF on the Barclays platform. The ticker code is VMID. These mid-sized UK companies are not so global, and therefore their fortunes will be more tied to that of the UK. This year the FTSE 250 has had a miserable time, and this ETF has returned a loss of 19%. Even over the last 3 years it's still negative. During recessions, mid-caps can often take a bigger hit than those of the FTSE 100. But coming out of a recession, they can often outperform many of the lumbering giants of the FTSE 100. The ongoing charge is 0.1% and a dividend yield is about 3.5% a year. The next most popular is the Vanguard All World ETF, VWRL. It tracks the performance of nearly 4,000 large to mid-sized companies from over 50 countries around the world. A large proportion of the companies will be from the US, and therefore a fair chunk will be in the tech sector. Here is a list of the top holdings in this very popular ETF. The return this year is -5% as tech stocks have been having a bad time, but over the last 3 years the total return including dividends is 29%. Some say that this is the only ETF you really need because of its global diversification. Ongoing charges are 0.2% and there is a dividend of almost 1.9% a year. So which Vanguard ETF have I chosen to invest heavily into? Well, surprisingly, it's none of the popular ones I've mentioned so far. The one I've picked has the ticker code VHYL. What I'm looking for now is even more great diversification, but also great dividends too, as this motivates me the most. I'm choosing the Vanguard FTSE All-World High Dividend Yield ETF. It tracks over 1,700 mid to large cap companies from around the world which pay higher than average dividends. This screen shows the sectors you would have exposure to. It's interesting to note that this ETF does not have a high exposure to the tech sector, which has had a very bad time recently. Here are the top holdings in the fund. Over the last 3 years, the return has been nearly 20%, and despite market turmoil, it has returned nearly 3% so far this year. Ongoing charges are 0.29% and the dividend yield is 4%. It might be interesting at this point to compare VHYL with the massively popular VWRL. Many would say that VWRL would do better over the long term, and they definitely have a point. Over recent years, it has indeed outperformed its high dividend counterpart. Much of this has been driven by the rampant march of tech stocks, and VWRL certainly includes a lot of US tech. But are things changing? Will the tech stocks do as well going forward as they have done in the past? Or are companies with strong balance sheets which pay reliable dividends turning the tables? Certainly over the last year it's VHYL which has looked far more impressive. In the very long term, however, my guess is that VWRL will probably still do better, and buying VHL may well be suboptimal. But it's the dividends that motivates me, and I'm in this for life, and maintaining motivation is such an important aspect. I can maybe liken it to a choice between two different jobs. One pays the higher salary, but is a bit dull and you quickly become disinterested. The other pays less, but it inspires you and maintains your enthusiasm for the long term. I did something else which was suboptimal from a financial sense, but it enabled me to pay off my mortgage in 10 years. Click this link to find out how I did it. This graph shows how my own dividend journey has progressed since I started in 2009. Click here to see how much my portfolio pays out each month, and click here to see a really simple way in which you can start your dividend journey today. Let me know in the comments what your favourite exchange traded fund is. See you next time and happy investing.